presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compac Market Wrap YouTube update for February the 23rd, 2026. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. A quick housekeeping note, if you'd like to subscribe to this channel, just go ahead and click on the subscribe button. So whenever I post an update, you'll be notified and you can watch it at your convenience. Also, if you need help with your portfolio, right now you're getting a little bit concerned, we're getting cusp of maybe a pullback, maybe a correction in the market. How's your portfolio going to stand up for that? Give us a call or send us an email at invest@compac.com or just give me a call at 800-388-9700. Looking at the numbers last week, we did gain 1.11% for the week, and we're up about 1% for the year. So market really hasn't gone anywhere. It's gone back and forth, up and down, really has not gone anywhere at all. NASDAQ is down about 1.47 and the Dow is up 3.44. The big gainer this year has been emerging markets, which are up 11.69, and then we're seeing the EFA also up 8.77%. Best sector this year has been energy, which was the worst sector, one of the worst sectors last year. It is up 22%. Materials are up 16%. Industrials up 14.3%. Financials, infotech is sort of right down here at the bottom. These were the big, basically the Mag 7. That's what we're looking at there. Oil also up on the heightened geopolitical tensions with Iran. That's pushing oil a little bit higher. And what happens with Iran, I think, is also concerning this market a little bit right now. If it's a limited airstrike, it is what it is. But if it's a prolonged, drawn-out sort of campaign, then it could become a problem. And what does Iran do in response? Does it fire missiles back at U.S. bases, which are within ranges of Iranian missiles? And what kind of damage can they do? That is something that is concerning right now. But there are more talks scheduled this week. Hopefully the Iranians will accept that and go from there. Also, we're looking at bonds, interest rates down slightly. We're looking at lower rates overall. That's what we're seeing. High yield was up more, which shows that the overall market is still not worried about a recession. As long as high yield, today high yields were down quite a bit, but they're still holding up sort of sideways right now. The difference, a lot of people have been talking about AI and the software stocks and all of that have been a problem. But if you look at saying it's a bust, that it could come like the dot-com bubble. Dot-com bubble was based on a lot of borrowed money. If you look at 2000, there was a lot of dot-com bubble. There was a lot of borrowing going on in 2000, 2001. If you look at 2024, 2025, yes, it is the AI. They have borrowed money, but very little. Yes, it is also going up a little bit more in 2026, but nowhere close to this kind of leverage. And that's where there were companies, and these companies are still making profits. The difference was the dot-com companies were not making any profit. They were based on expected profit or projections that they might make money in 2020, 2025, 10, 15, 20 years down the road. The companies that we're seeing in AI, Microsoft, Google, all of these companies are turning profits right now. We did get the first quarter GDP a lot lower than expected. It was expected around 2.8%. We got it around 1.4%, about half of what was expected. But the market shrugged it off, saying it was due to the government shutdown and that what caused. We're looking at the PMIs are still good. The purchasing managers above 50, which are both showing an expansion in the economy. Consumer sentiment at 56. We're looking at factory orders coming out just about as expected. Big one is going to be core PPI coming out end of this week, and it is expected at 0.3. Previous was 0.5. So inflation still remains sort of unchanged. That's what we're looking at. Technicals markets back below the 50-day and the 20-day moving average. 68.90 and 68.96 is where we're sitting on that. We're close to 68.30 today. Still in this range right here. If we break out below that to the downside, then we can see a little bit support around here, 67, but the main number becomes right around here at 65 and change. And that could bring us down about 7-8% in the market, or give us a healthy correction in the market. And I would not be surprised to see that. The two things I'm looking at is high yield, if it starts to go down, and the NASDAQ, and I'll talk about that in a second. Weekly charts, 68.39. We're sitting right about there at the 20-week. We break it, then we're looking at about 6,400, which is the 50-week moving average on the downside. Looking at technicals, NASDAQ, today we are right around 22,600. The big number that I'm watching right now is the dot plot. You can see when these dots right here, my dot plot, and the market is here, it is in a positive mode. Here in March, you can see the market made a high, the dot plot turned negative, and each one of these little dots is 1 week. So you can see we turned up last year in April and stayed up. Right now that number is 22,188. We are at 22,600. So we're about 600-700 points away from the dot plot turning negative. If he does, then I think I wouldn't be surprised to see 22,000 on the market, which would be down from 24,000, putting us down somewhere around, again, 7, 8, 9% on this pullback on the downside. If we break below that, that would be really negative. If we break below 6,500 for the S&P, then we're in for a deeper correction. But for right now, I'm looking for some kind of pullback, more consolidation over the next few weeks in the market, technically. Small cap still holding up. 123.71 is the 20-week moving average. And you have to look at weekly charts if you are an investor. If you're a trader, then you look at daily and 60-minute charts and things like those. If you're an investor, you're looking at weekly and monthly charts. Again, the international stocks still very positive. This is the MSCI ETF, which is the IXUS. And support is right around the 20-week moving average. We've gone up a lot, so wouldn't be surprised to see, again, some kind of pullback. But I like to see the small cap and the international emerging markets hold up better than the NASDAQ and the S&P. That would be a sign that it's time when the market goes down, they hold up. When the market goes up, they do better. That would be a sign, a time to maybe add some of these areas to your portfolio. Treasury yields were down sharply from this 4.33 area. We're down to about here. This is 4.9, and this is 3.9 and 3.95 and 3.9. As long as we're above 3.9, which is right about here on the charts, we're still okay. It will still show that this is just the market going back and forth, people getting concerned, buying bonds, getting out of stocks and things like that. If you get much below 3.9, then the bond market might be indicating that's a deeper correction is coming in the markets and people are getting out of stocks and going for safety of the bond market. That's what it might indicate. Or if the bond market goes down, interest rates go down because of lower inflation, that is a good sign. That's not a bad sign, but we'll have to see what is causing rates to go down if they do go down below 3.9, something to watch on the 10-year. Gold, which had come back, this looks like a fourth wave correction. Now we're starting to wave 5 to the upside, which should take us above this high at 5,100 for the NASDAQ, for the gold market. Looking at this, still high yield, still stuck in this range. Again, same thing as we're seeing in the stock market. As long as we're above 80.44 in the HYG, that's the ETF that I'm watching. This is the high yield bond ETF. As long as we're above that, I think we're okay. And that's what I would keep an eye on. It's just showing that the market, high yield, when that starts to go down, it shows that there's concern in the market. Those are my thoughts. Those are my observations. Again, if you'd like to subscribe to this channel, click on the subscribe button. And whenever I do an update, you will be notified. If you need help with your portfolio, if you're concerned with your allocations, send me an email at invest@compact.com or 800-388 9,700. Those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.